Assalamu alaikum students, how are you? I hope you all are doing good. So let's start the video with the concept we were studying in the previous video, that is methods of credit control. Let me remind you that RBI takes the responsibility of controlling the money supply in the country. Why so? Because through this they can manage the situation of inflation and deflation. So in the previous video, you just have learned about the general methods. We were studied about the 2 points, that is bank rate. Let me remind you that bank rate is the rate at which the RBI provides the finance to commercial bank. And when the RBI want to control the situation of inflation, they try to increase the bank rate so that the commercial bank will face a type of problem in borrowing the finance from RBI. Later on, there would be a tough for the public to get the loan from commercial bank. Through this, RBI can control the money supply in the country. Later on, we have studied about the second point, that is open market operation. It is nothing but just the sales and purchase of securities by RBI to commercial bank. Like the RBI sells out their securities to commercial bank. This process is known as open market operation. And RBI can control the situation of inflation and deflation with the help of this point. How? Suppose if RBI is purchasing the security from commercial bank, it means they are giving money to the commercial bank, then only they are purchasing the security from commercial bank. And it means the RBI is providing the fund in the economy. It will help to improve the situation of deflation. So just now I have explained to you the previous point which we have studied in the previous video. So now starting with the third point of general method of controlling the credit in the economy, that is variable reserve ratio. It is believed that this is one of the best method in the hands of RBI to control the situation of inflation and deflation in the economy. So basically, this variable reserve ratio is classified into two types further. That is cash reserve ratio. The next point is statutory liquidity ratio. We will study these points one by one. I will start with the first point, that is CRR. That is cash reserve ratio. Okay, clear. So, as I have told you that commercial bank is a financial institution which accepts the public deposit and lends to the public in the form of loan. So, are you understanding? It means we people are saving our money in the commercial bank, and it becomes a public deposit for the commercial bank. Like the money which you have deposited in the bank, it becomes the public deposit for the commercial bank. Then only the commercial bank use that fund to provide the loan in the economy to the public. So let's start. Like you are public, okay, and you are depositing your money in commercial bank. So deposit, it becomes the public deposit. And later on the commercial bank give loan to the public from this fund, from this public deposit. But there is a condition. What is the condition? That they can't give the whole amount in the form of loan to the public. Suppose the public deposited rupees, suppose just example, rupees 1000 in commercial bank as a saving. So later the commercial bank have to give a loan to the public. They can't just use this whole amount for giving the loan. They have to reserve some percentage of this deposit in the current account to RBI. Let's suppose the CRR, that is cash reserve ratio rate, is suppose 10%. So the 10% means 1000, 10% would be 100. Okay, you can just calculate here. It's 100. Okay, the commercial bank have to give rupees 100 to RBI in the form of cash reserve. What amount is left in the hand of commercial bank? That is 9,900. Now this amount, the commercial bank can use this amount for lending the loan to the public. So basically, in simple words, cash reserve ratio means the commercial bank have to reserve some amount of public deposit in the form of cash to the RBI. They just can't lend the whole amount to the public. So, okay, this is the meaning of CRR. Now, there would be a question in your mind that how, ma'am, the CRR can be a method of controlling the credit in the economy. How the RBI can use this thing to control the inflation and deflation in the economy. Let me explain you. Suppose there is a situation of inflation in the economy. Okay, I have told you that in the situation of inflation, the RBI have to decrease the money supply in the economy. It means the main target here is to decrease the money supply in the economy. And if RBI want this, then they will increase the CRR so that the commercial bank would left with less amount to lend to the public. Suppose here is 10%, they can increase to 15% or 20% so that the commercial bank would left with less money in their hand for the lending purposes. So in case of inflation, the RBI would increase the CRR, that is cash reserve ratio. Okay, and the thing which is done with the CRR is same with SLR also. But the thing here is the reserve should be in the form of cash. Whatever is commercial bank have to use this rate, they have to deposit that money in the form of cash. Okay, now I will move to the point, that is SLR. Let me explain you this point now. Wait students, I just have to correct a mistake which I have done in the video. It's a little mistake. While explaining the CRR and SLR point, I have just wrote 10% rate on the public deposit. In that example, the rate is 1%. I can't change the whole video for that purposes. That's why I am just instructing here you that the rate is 1%. I have wrote like this, 10,000 public deposit and CRR is 10%, but you have to write 1%. Make it very clear whilst understanding the point. Okay, it's a kind of little mistake. So the next point that is covered under variable reserve ratio is statutory liquidity ratio. The purpose in this is the commercial bank, in this case also the commercial bank have to reserve some amount from public deposit, but not in the form of cash, but in the form of liquid asset. Suppose in the previous point I have gave you the example that there is a public deposit of 1,000 rupees in the hand of commercial bank, and they have to take a reserve, that is cash reserve ratio, at a percentage of 10. It means they have to give 100 rupees for cash reserve. So later on they are left with 9,900. In the same way, in this case also, the RBI provides some percentage under SLR. It would also be rupees, suppose it would be 10% again. That 100 rupees should not be given to RBI in the form of cash, but they have to invest that amount in any liquid asset. The liquid asset can be marketable securities, or gold or governmental securities. It means it's up to the wish of the commercial bank that whether in which liquid asset they can invest the money. Indirectly, in this case also, they have to keep some money in these forms. Later on, they will left with the amount that can be lent to the public. So in this case also, RBI can increase or decrease this ratio. I mean, this ratio is decided by the RBI. So in this case also, the RBI can increase or decrease this SLR rate to control the problem of inflation or deflation in the economy. In this way also, if RBI want to control the situation of inflation in the economy, they can increase this rate so that the commercial bank will left with less amount for lending purposes. And if commercial bank is left with less amount, then there would be less amount in the hand of public also, and it would be very beneficial to control the inflation situation in the economy. So that's why it is considered as one of the best method in the hand of RBI to control the situation of inflation or deflation in the economy. And I'm going to give you the task that you have to find out the current rate of CRR and SLR, and you have to mention in your assignment also. So this would be your task to do, so that you can connect yourself to the current economy, what is going on in our economy regarding these points. It is an interesting point and you can connect itself. So let's move to the next point. The next category under the credit control method is selective methods of credit control. In the previous points, we just have discussed the indirect ways which are available in the hands of RBI to control the situation of credit, to control the situation of inflation or deflation in the economy with that methods. Now we have reached at those points which are directly giving the instruction to the commercial bank to control the situation. So let's start with the first point, that is rationing of credit. I mean, this is the oldest method in the hands of central bank to control the situation in the economy. And it was firstly used by the Bank of England in the end of 18th century. So what it means? In this, the RBI or the central bank just set an amount of loan which can be given to the public by a commercial bank. Let's suppose the RBI is saying that you can just give 10 lakh rupees to the public in the form of loan. So basically it is a very simple point to understand that in this RBI is just setting amount of loan which can be given to the public. Let's suppose 10 lakh, 1 crore, 2 crore, or also in this point also the RBI can categorize which sector can get how much loan. Industrial sector can get how much loan, the agriculture sector can get how much loan. So this amount is fixed by the RBI, and it's very simple. If the RBI want to control the inflation situation, then they can decrease the amount of loan which is given to the public through commercial bank. So it's very easy point to understand. The next point is, in this they just mentioned, who mentioned? The RBI just mentioned the amount of loan which can be given. It's limited. Okay. The next point is direct action. Let's suppose any commercial bank failed to follow the instruction which is given by the RBI in lending the loan, then what action can RBI take? Basically, RBI can deny in giving the finance to the commercial bank in the tough situation, in the financial problems. They can deny to giving the amount of loan for help purposes to commercial bank. RBI can deny. Okay, it's a kind of direct action. RBI is taking a direct action on those commercial banks which are failed to follow the instruction which is given by RBI. So it's a kind of direct action taken by RBI on the commercial bank. And this can be a very toughest situation, moral suicide. In this, the RBI behave very strictly for the commercial banks. They can even cancel the banking license of the commercial bank if they fail to follow the rules and regulations regarding lending the loan amount. Basically, they can just cancel the license of the commercial bank who are not following the rules of lending the loan. Okay, so it's a kind of harsh decision which is not generally used by the RBI. It's a point just given in this heading. It is used when there is a terrible situation when commercial banks are not following the instruction. So let's move to the next point, that is publicity. Suppose there is a situation of deflation in the economy. I'm just talking about inflation, now I will talk about deflation situation. In this situation, the public have less amount of money in their hand. It means here, in this case, the RBI has a target of increasing the money supply. Let me write the target first. To increase the money supply. And suppose the RBI told the commercial bank to increase the consumer credit schemes, okay, so that the public can easily get the loan from the commercial bank, and it would obviously increase the money supply in the economy. So it means the RBI is telling the commercial bank to introduce lot of consumer credit schemes, and that should be known to the public in a few time, and they can use this medium, publicity. They can just mention these schemes in the newspaper, they can just give advertisement on the television, so that lot of persons can attract to that policy, to that scheme. Then only they would be able to know the schemes of commercial bank through these advertisements, through this media of communication. So this is one of the another point, that is publicity for the schemes, so that the public can easily get the loan from the commercial bank. Now let's move to the interesting point which you can also relate with this. That is regulation of consumers' credit. You know what? When you people go to buy anything on installments, you know very well you have to pay the down payment first. Then you have to give the installments monthly, quarterly, half yearly, yearly, depend upon the the policies given by the financial institution. And here in this case, RBI can increase the down payment amount to control the situation of inflation in the economy. Are you understanding? Suppose you went to buy anything which is costing rupees 10,000. Suppose you can say a second-hand computer. Sorry, a computer of old scenario, or a laptop which is 10,000, costing 10,000. The down payment can be 1,000, 2,000, but RBI can increase the amount of down payment. Suppose 5,000. So it would be very difficult for the public to arrange this amount, this heavy amount for down payment purposes. So they would discourage to take this type of consumer credit. So it means it is a kind of direct action, direct thing which can control the situation of inflation or deflation in the economy. In simple words, the RBI can tell the commercial bank to increase the amount of down payment in consumer credit schemes, so that they can control the situation of inflation or deflation in the economy. So let's move to the next point. So the next point which is covered under the selective method of credit control, this is the last point here, that is changing the marginal requirement on secured loans. Let me explain you first this term, that is marginal requirement. What is it? You know very well what is secured loan. While suppose you are taking any loan from the commercial bank, then you have to give some security to the commercial bank so that they can cover their amount if you fail to pay the amount of loan. Suppose if you are taking loan of rupees 10 lakh, I mean they would ask you for the land property papers. So that if you fail to pay the amount of loan to the commercial bank, then the commercial bank can take over your land for that purposes. That is known as secured loan. It means you have to give the security to the commercial bank to take the loan. So, I mean, it's very understood. And if you are taking, suppose, if you are taking a loan of rupees 10 lakh, the amount of security would obviously higher than the amount of loan. It can be rupees 12 lakh. So the what is marginal requirement? What is marginal requirement? It is the difference between the amount of security and the amount of loan. So here in this example, the marginal requirement is 2 lakh, rupees 2 lakh. In the short form I will write here, MR, that is marginal requirement would be rupees 2 lakh. Now, are you understanding this? Changing the marginal requirement on secured loan. I mean, RBI can increase this amount so that the public would find difficulty in taking the loan because they have to give a high amount of security to the commercial bank. So this is the kind of thing which discourages the public to take the loan. And again, I mean, in the exam also, while explaining these points, you have to first explain the meaning, then you have to relate this point with the situation of inflation and deflation. That is the main motive of this heading. How the RBI controls the situation of money supply to situation of inflation and deflation in the economy. And you have to relate these things with these points first. Now you understood the meaning of marginal requirement. Now I will relate this point with the inflation and deflation situation. I have told you many times that in the time of inflation, the RBI would like to decrease the money supply. In the case of inflation, in the case of deflation, the money supply would be decreased. This is the target, and in this it would increase. So with this, the RBI can increase the marginal requirement on secured loan so that the public would find difficulties while taking the loan, and it would discourages the public to take the loan. Then they can decrease the money supply in the economy very easily because public is finding difficulties while taking the loan. And in the case of deflation, if the RBI want to increase the money supply, then they want the public to take more and more loan from commercial bank, and it is only possible when the RBI is decreasing the marginal requirement, when the public have to give less amount of security for taking loan, not less than the amount of loan, but decreasing this requirement. With this, they can control the situation of deflation in the economy. So that's all from the point of selective method of credit control. Let's move to the very important terms, repo rate and reverse repo rate. Let's start. So I have told you in the functions of RBI that lender of last resort. It means the commercial bank last hope in the time of financial problem is RBI. I mean, they move to the RBI to take the financial accommodation for clearing their financial problem. So in that case, the repo rate is used. You know what, commercial bank go to the RBI to take a loan without interest. Okay, they can just give their security. Security means the amount which is invested by the commercial bank or any marketable securities, they can just give to the RBI as a security and take the loan from RBI. Okay, let me explain you by giving the example. Okay, now the commercial bank want the loan, want the money from RBI. They will go to the RBI and offer their securities, their marketable securities, and telling the RBI to not to sell these securities to anyone. We will come later and purchase this security from you again. I mean, this is the full form of this is repurchase agreement. Repo means repurchase agreement. First, they are giving the security to the RBI so that later, after meeting their financial problems, later they can come to the RBI to take their securities back. Okay, at what rate they will take their securities back is known as repo rate. Suppose they are lending the amount of security, this is suppose 10,000. Okay, and the RBI can set a rate at which the commercial bank can repurchase these securities after some time, so that the commercial bank can come to the RBI after some time and they can repurchase their securities, but not at the same amount. The RBI can impose a rate on these securities so that the commercial bank can repurchase that security. Now, you would say that what is the benefit of RBI? Suppose the amount of security rupees 10,000. Now, suppose the repo rate is 10%. Okay. It means the RBI, wait. So that suppose 10% it is. Then the commercial bank have to give rupees 11,000 for purchasing the amount of security of 10,000. And it can be the amount of security in the market right now of this 10,000 rupees would be 10, 20,000, 30,000. We don't know the changes which is occurring in the market. But that's why they are just imposing a particular type of rate on the security so that the commercial bank can repurchase that security from RBI. This is also one of the type of thing which can be used by RBI to control the situation of inflation and deflation. They can increase this repo rate to control the situation of inflation and decrease the repo rate to control the situation of deflation. So now let's move to the reverse repo rate. In this case, the commercial bank money from RBI, that's why they are borrowing the money from RBI. But in this case, suppose the commercial bank is having a surplus amount of money with them, they can borrow. Who can borrow? The RBI can borrow the money from commercial bank by giving the rate of interest, you can say, but we can't use the name of interest here. We have to use the amount of reverse repo rate. It means the RBI is providing interest on the amount which is borrowed by RBI from commercial bank. In this, commercial bank is giving the money to RBI and they give amount of interest, that is the reverse repo rate on that particular amount to the commercial bank. Okay, and if they are increasing this reverse repo rate, it means the commercial bank can invest more and more money in RBI to get amount of interest. Okay, so in this, basically the rate which is provided by RBI on borrowing the money from commercial bank. So this is one of the another point which can be used to control the situation of inflation and deflation. And these points are very important to understand the economical situation in the country, and you can study as well also very interestingly what is happening in our country, how this rate is moving to control the situation. It is very common topic which is discussed at every economical debates. So now it's over for today's video. let's move to the assignment questions which you have to complete on time. So here are the assignment questions for you. The first question is, what is variable reserve ratio? You have to explain the point CRR and SLR in this with the current rate by finding out. The next question is, explain the selective methods of credit control. The third question is, what is repo and reverse repo rate? So that's all for today's video, and you have to complete these questions on time. Assalamu alaikum. Take care.